passive strategy is relatively trivial. I think from a portfolio management standpoint, I think you can achieve that relatively easily. We have conducted, we have done some research around that. So starting off, global equity index, what would it take to remove a certain percentage of, carbon footprint? And our conclusion, and that was consistent across region, is that by just using a 50 basis point of tracking error, you can remove about 50% of your carbon footprint, right? So it's pretty easy. But what that means is that essentially you're just divesting away from divesting away from those big emitters. And we know that right now, making up a big chunk of global index are tech companies, right? And if you look at that from scope 1, scope 2 type of reporting, you just realize that their footprint in terms of carbon is very low. So, well, I think out of that, what's the key takeaway is first, you want to achieve with that, we want to achieve decarbonization goal for the planet. That's for sure. But what is also important is that we have to be true to ourselves. We are not all environmentalists. We do have our fiduciary duty, which is to deliver a return, right? So I think our view, the big difference is that, well, there are risks related to ESG, but that new environment, right, that is also creating a huge opportunity to generate alpha. We've been long advocating that a traditional approach and traditional, asset classes, we were saying sort of like compression in terms of the premia you would get in the future. So these new trends offer tremendous opportunities in terms of meeting your long-term return objective. So yeah, that would be the big difference I see.